Welcome to Value Investing, the Starvine Way, where my goal is to help you learn more about value investing and compounding wealth with a long-term focus. I'm your host, Stephen Coe, founder and portfolio manager of Starvine Capital. Our guest in this episode is Kim Shannon, a decorated value manager in Canada. I had the pleasure of meeting Kim at a CFA conference in Singapore in 2013, but it was through Dr. George Athanasakos, our previous guest, that I was able to reconnect with Kim for this interview, which was recorded on August 26, 2024. The reason I sought out Kim is that she is unique on different levels. For one, she has over 4 decades of industry experience. She has worked on the buy side through the biggest market tumults over the last 40 years, and so there isn't much that Kim hasn't seen. It isn't easy to find a professional investor still in the field, currently practicing and managing money, who can share their recollections of the crash of 1987. And moreover, it's difficult to find investors dedicated to the value discipline who have managed money through so many market cycles. And so to be able to listen firsthand to Kim's lessons from those major corrections and how she navigated them from a value manager's perspective is invaluable. Another way that Kim stands out is her status as founder of Sionna Investment Managers, one of the largest independent investment firms led by a woman. Although it isn't uncommon to see women analysts and portfolio managers in the investment management field, women are still underrepresented today. But the underrepresentation is especially pronounced at the founder level. As lead portfolio manager on Sionna's large cap, all cap, and focused Canadian value strategies and co-lead on Sionna's high conviction strategy, she has received numerous awards. So many that it's best that you visit Sionna's website if you'd like to see them all. But I'll name some of her past awards now. Morningstar Fund Manager of the Year, the RBC Canadian Women Entrepreneur Award, Canada's Most Powerful Woman Top 100 Award, the Rotman Women in Management Association Top 10 Award, Entrepreneur category, and the Rotman Alumni Lifetime Achievement Award. Kim also co-hosted the female-led Variant Perspectives Value Investing Conference in 2019, which featured Warren Buffett as a keynote speaker. In this interview, we covered a lot of ground. Kim's origins as an investor, her investment philosophy, the importance of having a great mentor, how she successfully steered through big market collapses, the paucity of women in investment management, and what it takes to make it in the industry. I hope you enjoyed this episode as much as I did. Thank you for joining me, Kim. I really appreciate your time, and I'm excited to have a chat with you.
Perfect. Thanks for inviting me on, Steve.
Yeah, my pleasure. So first question is, could you elaborate on how your investment philosophy was shaped? How did you get interested in investing and, moreover, value investing? And what are the core principles that guide your decision-making process?
Well, I entered the investment industry 40 years ago, and it wasn't something that I particularly had set my sights upon, as you can imagine, 40 years ago. But I was looking for a challenge, an intellectual challenge and stimulation every single day. I wanted to learn something new every day. And I literally fell into the field by hearing a little bit about the markets and deciding that this would be challenging enough and worthy of my interest. So I took some courses. I became even more intrigued by investing and then started looking for a job as a value manager and lucked out, got a job at Royal & Sun Alliance working under a portfolio manager who really taught me the craft of value investing. And I think it's really important to learn those key skills of how to invest through a mentor boss who already knows the ropes and has a lot to teach you. And coming from a science background, John DiTommaso was the man who hired me. He had been actually a philosophy major, so a very different skill base. And he believed in value investing, and his central tenet was that stocks would revert to their mean given time. And my science degree in me said, well, where's the proof? And he didn't have any. And he said, Kim, you just watch, you will see they do it. And I found after about 2 years of working with him that he was absolutely right. These stocks started reverting in the direction that he suggested. And he was fairly fond at that time of buying what I would call cigar butt small cap value stocks. And to watch these stocks just start moving in that direction was a real eye opener for me. And I continued to work with him for 5 years and became a very strong believer in this. Years later, I read Andrew Smithers' book and found out that, Smithers had done some analysis and concluded, now this is research from 30, 40 years ago, that approximately 90% of the stocks that he was looking at reverted back to their mean within 5 years. So there was my proof that there was really good historical justification for reversion to the mean. But you do see reversion to the mean in almost all data series.
Was value investing something that through your job and through Mr. DiTommaso that you discovered, or was it something like you chanced upon a biography of Warren Buffett and saw how amazing it could be?
I was really intrigued about investing, and I didn't really know different styles. It was John DiTommaso who introduced me to Warren Buffett. And for the longest time, I had Jimmy Buffett in my mind much more frequently than I had Warren Buffett in my mind. And it's interesting to know they did become good friends and shared information. There's a rumor that he's a nephew, but it turns out that he's not. But he got a lot of good advice from Warren. He was a very successful rock singer based on his interest and communication with Warren. So, no, I did not find it myself, but obviously we all got exposed to Warren throughout our careers.
Given your professional experiences, I know it spans cycles. I believe you're a professional in this field even through the tech bust. Can you share how the value discipline in particular has guided your decisions through these past market booms and busts?
Love to do that for you. I think a key tenet for me has always been the price that you pay for an investment has a significant impact on your long-term results. If you buy a stock at a very expensive price where there's a lot of hype embedded in the stock, you are at risk of getting a very modest return. But if you buy a stock that's contrarian, overlooked, underfollowed, possibly in some kind of trouble, it's very inexpensive, you've done enough work to be confident that it can recover, that these problems are all temporary, the opportunity for an excess return for patient investors is very strongly there. And the value style has been proven throughout history. Fama and French has done numerous studies showing, over almost a century of data, value has clearly outperformed the growth style over that time period. It is a support to myself in terms of sticking with the method and investing in that way. But in terms of the experience throughout market cycles, and I started in 83, so probably the most memorable early experience was living through the 1987 stock market crash. And for younger listeners, the market was down close to 25% in a single day and recovered fairly rapidly over the next year. But it was a shocking decline, and we have not seen that size of decline since. But it was very interesting to me because we had been moving away from the most expensive names, hugging the cheapest names. We had been underperforming leading up to October 19th. And then we massively outperformed subsequent to that. So it was a real big wake-up call for me that in bad collapses, how well value tended to protect investors. And that really, once you've experienced that experience, that has a very important impact on your psyche. And my fear for a lot of investors today is they really haven't had too many exposures to that. They got a brief window in 2022 where we saw value significantly underperform growth, but that was quite brief actually. And then you've had most of a decade to 13 years where growth has really outperformed value. The next major exciting part for me in my career was probably 9/11, when the Canadian market reopened. Every stock was down 20 to 30% overnight. And they stayed weak for almost a week. And when I use a very quantitative model at the front end and then marry it up with fundamental analysis. And I sat back when the market reopened and ran the model and saw that it was the fifth best buying opportunity of my career to that moment in time. And although I was as scared as everyone else, we started buying these bargains in the marketplace, and that was very additive to the return. And then I think the other major market correction that really stands out for me as a lesson for value managers was we got a big hint in the summer of 2007 when the asset-backed commercial paper market blew up. And it became quite clear that there had been a lot of financial risk that had been layered into the markets. And so I actually spent a whole year quite terrified that there was a correction coming almost every moment. And there was a lot of bumps along the road. But it wasn't until October, September, October of 2008 that you got the big wallop market. And again, that was quite edifying for value managers who could batten down the hatches for over a year. We had entered the summer of 07 overweight financials. We felt that there was troubles in financials. We felt that most of the troubles would be felt in the US. But after the asset-backed commercial paper problem happened, we said, oh no, I think the Canadian banks will be hit by this too. Not as badly, but they will. And we went underweight Canadian banks before the correction, which was quite additive to returns.
Wow.
So these booms and busts, I'm trying to give you a sense of these busts in particular, where value always lags in strongly up markets, and we get rewarded in the corrective phases. And you have to be patient and wait for those.
And especially for the value style, which, well, I suppose any style can underperform or outperform for long periods. But in your case, I think it's kind of unique. I don't know many managers who are in the industry, let's say the 87 crash. There's been so many cycles you've been through, and yet each big one I personally been through, let's say as an analyst in 2009, you really don't forget it. It really imprints on your mind. Like I really remember being in my colleague's office looking at the Bloomberg, and it was so red. It was just such a sight, right? I mean, in a way so beautiful, right? And I remember someone saying, one of the portfolio managers, this is at UBS Asset Management, I think he was buying one of the US banks. I believe it was Wells Fargo. And he said, I might as well buy now because if everything goes down, it doesn't matter anyway. It was that stark of an experience.
Yes, they're very telling on your psyche, and you learn a lot from them. And I also think that they're very important to have lived through a couple, because the key to being a good value manager is to have a contrarian approach to the market, becoming skeptical about novel, new, unproven investment approaches or new technologies. And the concern that there could be hype embedded in the new and novel, and that deep knowledge of how painful it can be when that new and novel gets corrected, so that to help you resist and stay away from what could be a very tough experience for a growth manager from time to time.
One characteristic of value is valuation, and I could see that for yourself, it's a core pillar of your discipline. Does it seem to you that during periods of market excesses, no one talks about valuation, or they find a way to brush it aside? But to me, that's kind of an anecdotal way to know it's a big red flag, isn't it?
It does teach you that the market is riskier. And it is possible for an investor to sort of rotate away from some of the more speculative names into the bargains. And in any market, there's a variety of price ranges available in the marketplace. And you can roll away and hide in the weeds of a market. And I think perhaps one of the most exciting opportunity for investors in the marketplace today is the extreme divergence in valuation between the Magnificent Seven and all the other stocks in all the other major markets of the world. And we're all going to learn a really interesting lesson, in my opinion, in the fullness of time, because historically, every time we have seen wonderful, exciting, high growth stocks trading at these levels, we have seen them come back closer to earth. And very few stocks can sustain the implied level of earnings growth than the valuation levels that we're seeing embedded in the Magnificent Seven today. This is history being made, and we will see in the fullness of time how this ends overall, and it'll be a great life experience for all of us. But to be clear, as a value manager, we are not in the Magnificent Seven. We're betting against it. Time will tell.
So, for instance, I love Apple product, but I don't like the stock.
Right.
That's probably just one example.
Well stated.
Pivoting a little bit here, you obviously have successfully navigated whatever challenges were in place in a very male-dominated industry, and you've built your own firm. What advice would you give to young women aspiring to enter the asset management field? I have 2 daughters myself, very young, of course. But are there specific skills or qualities you believe are essential for success?
Yes, I still believe that's true. I mean, certainly the industry is very different than it was 40 years ago. There's much less overt sexism in the industry, and there's a greater acceptance very broadly of the benefits of diversity in an investment team. So I think that the future will be different than the past. And so that's creates a great, interesting opportunity for young women today. But this job of being a portfolio manager is highly competitive. Some of the best minds in the world are in this industry, with some of the biggest amounts of talent and technology being used to help select securities in investment portfolios. So one has to ask themselves when entering this field, do you want to be a journeyman portfolio manager? And will you be content with being part of a team? Or are you intent on becoming a successful investment manager doing excellent work in the field? And I think the only way that you can be excellent in this field, given how demanding it is you have to have a passion for it. And you know that in your heart, whether it's a passionate interest or a place you'd like to be. And I think that it would be very challenging for someone who finds the notion of being an investing fun without ever becoming passionate about the craft of investing. So I think that's a key skill for men and women to be good in the field. But the skill levels, types of skills, I think that are embedded in the best of the people in the industry is, first of all, you have to be analytical and curious, that you want to find the right answer overall. You're certainly intelligent, but you have this je ne sais quoi ability of how to get into the soul of what makes this security hum. What are the key elements that are most important for this firm? And do you have a sense of how good they are at it and how good they could be in the future? And if they're as a value manager, you're buying stocks when they're usually a little bit off, they're down the route, they're in some sort of trouble, they're stumbling, or they've shot themselves in the foot. And it's about being decisive, being analytical enough to say, I think they got into this trouble because of X. Could it be purely cyclical, or is it just a weak management team that can be easily replaced? And are these issues that they're facing today insurmountable, or are they temporary? And can they be resolved? And can you make a great return on this stock? I think it's also important that you have confidence in your own opinion, because you'll certainly have lots of people with different opinion than yours. So you'll have to stand up to that. You also have to have good people skills, because inevitably you're having to sell your ideas. You'll be selling your ideas to your colleagues, your clients, the gatekeepers, and you inevitably have to have good sales and marketing skills. Again, you have to sell your ideas to your colleagues and clients. in order to succeed in this industry overall.
What you describe, it sounds like an inherently tough balance. Well, just on the investment front, especially as a value manager, because with value, or maybe with any style, things may not go your way for a few years at a time. So it's almost as if you have to have that staunch confidence to stand your ground, but at the same time be open and flexible to know when you made a mistake, for instance, as we all make them. But it's a really tough balance, isn't it?
Oh, you are clearly a value manager yourself, Stephen. The way you express that, it's coming from the heart and soul of a good value manager.
Well, I went through the last 10 years, so how can you not, right?
Yes. And the fact that we're stubborn enough to stay in it says a lot. And I think we will be vindicated in the end, because I believe that in inflationary environments, which we are in now, the last 4 years for value has been substantially better. And it's that the world hasn't quite accepted that yet, but they will. Only it's being blurred in the U.S. by the Magnificent Seven. But in the fullness of time, I think we'll see that is quite true. As it has been in the past, it'll be shown to shine through once again.
That's right. Now with maybe interest rates headed down the other way. But I'm very surprised when interest rates started heading up. You think all else being equal, asset prices come down. And then we've had, I suppose, again, AI kind of rally exactly when I never would have expected it. So
Right. But you look back in history, and I think this is about looking back at, how have irrational human beings interacted with financial market data in the past. So they're a really good guidepost to the future. When you look back historically, you see that the market goes through periods of disinflation and inflation. And historically, on average, those cycles tend to be approximately 20 years. Now, we just went through an incredibly long cycle. From 1941 to 81 was a very long inflationary cycle. And then from 81 till 2000 was a 39.5-year disinflationary cycle. So in my opinion, we're likely in a 20-year, roughly, inflationary cycle. And when you look at all the inflationary cycles, they've always come in waves. I'm not at all surprised that we've had a bit of a pullback. And in the 1970s, you also had a pullback of inflation in an election year as well. So this doesn't mean the inflation cycle's over, in my opinion. So we shall see.
And just for the layman terms, or the layman speak here, inflationary environments versus deflationary. Inflationary means maybe interest rates are pressuring upwards, maybe more sensitivity to valuation.
Yes.
And so therefore, perhaps more pressure on growth stocks.
I agree. That's exactly you perfectly described the system. So yes,
we just have to see that play out, right?
Yes. When inflation goes up, it affects interest rates. So interest rates go up as well. And the discount rate for growth stocks causes the valuations to come down. And meanwhile, Professor George Athanasakis, who I know you've interviewed in the past, he's done a fabulous analysis of a century of value versus growth, and concluded that when inflation's north of 2.5%, which it still is today, value outperforms growth by 11% annualized.
Looking forward to those few good decades.
Yes.
So one topic that's been in the back of my mind while we were speaking is Buffett's quote, and that is something along the lines of, I am a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. How does that apply to you? I know that you started your own practice, and one of your slogans is being fiercely independent at Sionna. So how does having your platform and customized how you wanted it to be help you be fiercely independent and think like that?
I completely agree with Warren, because it's very different when you are sitting at the table and you are in the pole position. You see the world in a different way. And when I sit down now with CEOs of target companies, especially the smaller cap stocks, I can really identify with their mindsets and what's going through their minds and the issues that they're dealing with. Because I'm there too in a much smaller way, but I am absolutely there. And I think that greater level of insight of the management team, their management style and approach, how they speak about their business, how they speak about their colleagues, speaks volumes about their management style and approach. And I think that there is a slightly better insight once you've sat in those seats as well. So I agree with Warren on many things, and that's another one that I would agree with.
So in one way, running a business, you can put yourself in the shoes of the CEOs you're speaking with. And in another sense, buying every share that you own on behalf of yourself or clients, every share is a piece of a business, right? And I think there's something pretty powerful about that in terms of being able to be long-term.
And I think it goes at many, many levels. We do ask that CEOs have a significant stake of their personal wealth invested in their firms. Similarly, fund managers themselves are being asked, I think quite rightly, to own a significant portion of their personal wealth in the funds that they manage for clients. And so as a CEO and as a fund manager, all of my wealth is invested in the firm and in client portfolios. So we all at our firm have an intensive focus on a single pot to the benefit of all of us. And I think that's reassuring to clients as much as it is that, we're that devoted to our own cooking, that is exclusively where we're putting our money.
So you definitely eat your own cooking at Sionna. And I visualize Louis Rukeyser grilling you when you pitch an idea and asking if you eat your own cooking.
Touche.
Yeah, great. Well, thank you so much for joining me for our first chat here. And I definitely hope to have you on in the future and to talk about other topics.
It was a treat, especially to be interviewed by another value manager. We were finishing each other's sentences. So that was a fun experience. Thanks so much.
Yes. And I also recently finished your book, which I thought was excellent. So thank you for that. Thank you for sharing your story in that. I know that's available on Amazon for anyone who wants to buy it.
Terrific. Thanks so much, Stephen.
Okay, thank you. We hope you enjoyed this episode. If you did, please like, subscribe, and share. Questions can be sent to podcast@starvinecapital.com. On a final note, thank you for the online reviews as that helps us get discovered.